Hey everyone, welcome back, and thanks for joining in. We're going to start our second session on news trading soon. So this is going to be the theory and practice, and I think we should have the time. I do want to talk about something that's actually going on with the yen crosses real soon. All right, let me know if the audio is coming through okay. Seems to be okay from my side, but if there's any issues, do let me know. If you want me to kind of boost the volume a little bit, we can try to do that. But other than that, let's start the second session for news trading. My name is Vidya Injero. Let's get this started with a quick disclaimer that any opinion discussed in this webinar or link to this presentation is provided as a general market commentary and does not constitute investment advice. News trading involves risk due to high volatility. Market reaction to news can be swift and unpredictable, which leads to higher trading risks and delays in order execution. So be very attentive when determining the volume of transactions and consider all possible risk factors. All right, cool. All right, there's going to be a promo code to double your deposit bonus as per usual, and you should have access to the private Telegram channel if you have registered through your email before on the website. If you just join in and you registered from the website, you should be getting that Telegram link on your email very soon. You should have it by now. If you don't, please contact the customer service and they should be able to help you out with that. Okay, so a little bit about myself. I've been a full-time trader with over 20 years of experience, and I've been a professional trading coach and technical analyst since 2007. My expertise is in Ichimoku Kinko Hill, which is a Japanese charting techniques. I'm also a director of Zenifix, an independent market consulting company. I've been a guest speaker at Trading Investing Expo Invest Fair in Singapore, as well as the ATAA and the APTA conferences, which is the Australian Technical Analysts Association and the Australian Professional Technical Analysts conferences. Okay? All right, so tonight we are going to talk about the theories, right? We did some practical examples last Friday, which is something that we kind of do every month, right? We do our live NFP trade, and then on Wednesday we will be doing our live CPI trades. But before we go on to the Wednesday session, it's useful for you guys to understand what kind of pending orders that we are actually going to be using. We did that last Friday, but because it was more of a live trade session, everything has to be on the go. I'm going on the assumption that a lot of you guys understand what's really going on, but if you are new and you want to refresh your memory a little bit about news trading, this is going to be the session for you, because we are going to go through some pending orders and when to actually use those pending orders. Okay, so we will talk first about the advantages and disadvantages of news trading, the most profitable news flow trading. Obviously that's going to be the NFP and the CPI numbers, and then we have the three main phases of price movement, and this is something that we need to understand before we delve into news trading. There are going to be some general rules for news trading as well, and then there's going to be examples of the pending orders, and then we will talk more about the buy stop and the sell stop strategy, which is something that we employed during the NFP sessions as well as the upcoming CPI session. And then there's also the buy limit and sell limit strategy, which is something that we kind of showed as well last Friday on the Euro USD. All right, and then we will talk more about trading after the news release as well. Okay, so this is going to be the code that you should be using if you're depositing into your Octa trading accounts. That's going to double your deposit bonus, or it's basically 100% deposit bonus. This is going to be non-farm 2024, so the code is non-farm 2024. valid until the 31st of December 2024. Okay? All right. So let's go through some of the advantages and disadvantages of news trading. By the way, if you have any questions about what we were talking about and you want more clarification, you don't have to wait for the Q&A session towards the end of the webinar. You can ask on the chat, and once I go through several slides, I'll take a look at the chat and see if I can answer those questions before we move on to the next slides. Okay? All right. So let's talk about the advantages first. I think advantage number one is that all the necessary information can actually be found in the economic calendar, so there's no need to delve deeply into technical and fundamental analysis. So a little bit of a reminder here, news trading, it's a different thing to fundamental analysis, okay? News trading is us trading the news when it's released, and how do we actually react to the release, right? I mean, how do we figure out with a certain strategy how to take advantage of that volatility that happened in a short period of time. So that is news trading. Fundamental analysis, it's different. Fundamental analysis, it's really more on doing research for a certain economy that you're focusing on. So for example, if you're focused on the US dollar, you really need to understand what's going on with the US economy. How are they performing? Is the economy healthy? Are they growing? What kind of state they're in? Recession, deflation, a lot of this stuff there. And to figure it out, you need to look at a lot of different factors, right? You can look at the GDP, you can look at the inflation numbers, the unemployment numbers, the manufacturing numbers, and also the import and export numbers as well, to kind of figure out what that country is up to, in terms of their health. Are they doing well? Okay, so you need to kind of focus on those, and you need to do a lot of research, and you're understanding it. For fundamental analysis, it does take time, right? We can learn about those economies, economic studies in the uni, for example, or at school, but in real life practice, it is a completely different thing. And I take economics in uni, and does it help? Yes, it does help, right? But to really understand it and put it into practice, that's a completely different thing. And it's also ongoing, so you need to be updated all the time. So that's fundamental analysis. News trading, you don't need those, okay? For news trading, you just need to understand what are the possibilities when a certain news is released, if it's above consensus, if the previous number get revised, what you should be anticipating, right? So we're really reading into the now of the news release, while the fundamental analysis kind of look at the past to figure out where is it going to go in the next 3 to 6 months. There's going to be that fundamental delay, but with news trading, it's going to be instant. It's going to be immediate in terms of the reaction. Okay. So news trading, I think it would be an advantage as well, because a lot of traders that maybe don't have the time to delve too deep into the technical side of things, or maybe the fundamental side of things. They just want to jump in. They understand the mechanics of news trading, and they can actually trade out of those. Okay. Events in the calendars are also ranked in order of importance, which helps in making adequate decisions, right? I'm actually going to show you a calendar, and this is something that I use. It's called Trading Economics, right? I find this very useful. It's very complete in terms of what you're looking for, previous data and what's coming out in the future. But you can kind of sort it out with the impact, right? I mean, if we take a look at the data for today, just looking at today, wow, there's a lot of data that comes out from Japan, from Germany, from France, from the UK, from the EU, right? Are all this data important? Are they going to be reactive in the market? No, they don't. All right. So you can actually kind of filter it out by the importance. Obviously, that would reduce the impact on what you're looking at. I would go, if you're just starting out with news trading, I would just go with the highest impact, because these are the news that could have the highest probability of triggering a volatility in the market. Okay. So obviously today we're past that. Obviously we have the euro balance of trade. We have a lower balance of trade coming out from Germany, and you can see the impact on the euro today. Kind of just dissipates a little bit. So yeah, does that move the market? Yes, it does move the market specific to the euro itself. Tomorrow morning, we're going to have the USDJPY consumer confidence, which is coming up from Australia. Typically, it is not that huge of an impact because the consumer's confidence is not really the main focus in the market right now. So you kind of need to understand the context of what's going on as well. But obviously, the key mover is going to be your inflation rate, which is going to be on Wednesday, and this is when we're actually going to be trading live. Okay, all right. Let me move that out of the way. Okay, so you can rank the order of importance, which helps in making adequate decisions. You don't have to sit around for every single news because not every single news is going to have that impact in the market. So you really want to be focusing on those high impact news, and you can actually rank it to save time. Okay. Publication of statistical reports noticeably increases volatility, allowing traders to potentially earn significant profit in a short period of time. And what makes us different from investors, from being a trader and an investor, for investors, they typically tend to avoid high volatility. They don't really want to be invested in anything that is highly volatile because they want to see growth. They want to see less volatility. They want more stability. But for traders, if we're looking at a market where there's a lot of stability and not a lot of volatility, I'll be honest with you, sometimes it gets really boring, right? We don't actually see a lot of price movement. One currency pair that comes to mind is actually the Australian dollar, and I already put it out on the Outlook today that the Australian dollar is actually in a stable phase at this point in time. So it's technically not trending. It is just stable as it is. There's actually a lack of volatility. Now, being a trader, to profit during the day as an intraday trader, for example, you need that volatility. You need that kind of something that moves the market, right? Something that triggers that range to widens up a little bit. That's when you can actually jump in on a trade and see a significant gain in a short period of time. So traders always look for volatility, while investors typically stay away from volatile assets. So I think that's kind of very clear. And you need to understand this, whether or not you consider yourself a trader or more of an investor mindset. Either way, it's completely okay, but we are talking about the context of trading. So we are going to be looking for that volatility. In fact, we love that volatility because that's when we can generate a quick movement in the market. Obviously, you still need to manage your risk, because if you don't manage your risk, it could actually be a huge loss for you as well. So it goes both ways, but that short-term volatility is what we're looking for in news trading. Okay. Now, the simplicity of a strategy, right? You just have to know how to open and close the orders without the need to learn any complex formulas. And this is something that I have given examples every single month since last year. We've already started the live NFP sessions and the live CPI sessions for a year now, and we don't use any complex strategies. We don't use any complex analysis at all. In fact, we set up our trades about 5 minutes, 3 minutes to 5 minutes before the news gets released, and that's pretty much it. So it's actually really simple in terms of the strategy. We are trying to cage the market, and we are going to be looking for that first initial reaction. That's where we want to be in. Okay, so not much of an analysis, not much of complex formula. You don't actually need to use a lot of the technical analysis knowledge, because during these releases anyway, those technical analysis typically goes out the window anyway. So there's going to be a lot of noise, there's going to be a lot of flurries in the market, and we need to use a different strategy. And the strategy that we use, they're very simple, and they're based on the pending orders that we are going to be talking about tonight. Okay. Also, minimal time expenditure on trading. You know exactly when to access the trading platform and what actions to take. Moreover, the trading process itself can be completed in just a few minutes. And I think last week on Friday, it does take a while because we're leaving the position open for projected targets. But in some of the previous sessions, I think the record, and I still have this because that was really unique. I actually timed it. It was actually 54 seconds to close the positions, right? So we have our positions open, and within that 1 minute time window, we got out of our position. So it can actually be very quick. And the thing is, when it's actually going to be scheduled to be released, right? Those data, we know when they're actually going to be released. So I don't actually have to, wait for the whole day to look at the market. I can just come in half an hour before the market news is going to get released, try to figure out what's going on, set up my orders, and that's it. Get in, get out as quickly as we can. So I think those are the advantages as well. All right. All right. I'll talk about the disadvantages and I'll answer some of the questions here because I think that's a very interesting questions there. All right, the disadvantages, okay? The market situation doesn't always develop as predicted by logical thinking and common sense. Sometimes what we have is you are going to find situations where traders in the market are actually buying on the rumors. And when the news gets released, and if it is as expected, they kind of go the opposite direction, right? So buy the news, sell the facts. I think that's basically what everyone is saying. So sometimes situations like that happen. Does that affect the long-term analysis of that news release? No, it doesn't. But in the short time period, we need to understand the context. We need to understand, hey, what is the market pricing in for, just in case, right? That's why we have several scenarios before the news gets released. Typically we discuss that during the NFP sessions, the CPI sessions. What could happen if this number comes up? If this one is above consensus and whatnot. Those are something that we discuss during the 30 minutes before our live trade anyways, okay? The other thing that I've already discussed was that not all news can cause significant market reaction. So you need to filter it out just like how I did. We just want to go with the high importance news, the high impact news, because not all news are going to generate that volatility. However, depending on what is needed by the markets, okay, so sometimes the market is looking for a very specific news, right? And with 2024, I think some of the specific news that the market is looking for is obviously whether or not inflation is coming off. The second thing that the market is looking for is whether or not the manufacturing or the production levels of every economy is actually going to go up. So those are very specific data that could actually have a huge impact in the market. If we take a look at last year, not a lot of focus on production, not a lot of focus on manufacturing numbers, but these numbers play a huge role in 2024 because of the context that the world is, kind of trying to see if the economy is going to avoid recession. So they want to see economic growth. They want to see production to kind of increase, the production output increasing, the manufacturing numbers going up as well. So it becomes all of a sudden a non-important, not high impact news becomes a high impact news depending on what the market is looking for. Okay. Now, the third one is if you're not able to accurately guess the market direction or analyze the situation incorrectly, you may experience significant losses. Now, as I say, there's going to be volatility in the market. Obviously, when we talk about volatility, those that are in the right direction will say that is going to be where they are going to generate a lot of profit. But if you don't manage this trade well, and if the market goes against you, that could actually destroy your account as well. So I think this is something that you need to take seriously. And I think there's already a question here by Syed here is that can we use heavy lots on trading with stop on both sides to gain few pips and make good profit? You can, but you need to understand the risk on both sides as well, right? If the trade goes in your favor, a huge lot size, if you just go for that 1 pip, 5 pip, 10 pips with a huge lot size, you are going to make a significant amount of money, right? That's undeniable. But at the same time, because leverage is a double-edged sword, your losses is going to be huge as well. So um, it really depends, right? I'm not gonna say it doesn't work. It is actually a very sound logic, okay? Because if we take a look at the trade history last week, and I'll just bring it up here. See if you can actually look at the trade history here. Um, if you take a look at the dollar Canadian, it's $242. The lot size is a standard lot size, so that's 24 pips, right? On the dollar yen, we close out the position. It's at $3, which $36, which is about four pips, right? So it's actually not much. Stop loss for the Aussie USD is at 99 bucks. That's exactly 10 pips as the stop loss. The Euro USD $72. That's only 7 pips, and the Pound USD it's just about 20 pips to our projected target. So again, it comes back to you, okay? If you can handle the potential losses, then by all means, go ahead, right? So you need to think about it on the scale of your equity. So don't come to news trading with a small account and then you over leverage it, opening a huge position that you're risking a margin call instantly if it goes against your position. So I would say the safest thing to do is to scale with your equity. Obviously, you need to understand the risk. I can't talk about risk to everyone on the same level. Everyone is going to have a different risk profile. So, you know, is it right? Can you do it? I say you can do it, but is it advisable? Probably not, because you're exposing yourself to a huge risk as well. You can do it if you have a huge equity, and if you think the market going against you with that huge lot, it's not going to be a big problem if it's only about 20 pips. But you have to think about it logically. If your stop loss is 20 pips, the logical solution to that is that your target should also be 20 pips. If you're aiming for 5, then your stop loss should be about 5 as well. Because once you start going with the threshold of risking twice the potential profits, that's not going to work out in the long run, right? Statistically, it's not going to work out on the long run. From experience, I can tell you this, you will fail, okay, guaranteed. I've seen a lot of traders become successful. At the very same time, I've seen a lot of traders kind of just fall out of the race, okay? Because of over leveraging and not thinking about the proper risk. So it is risky. How much room should we give for buy stops and sell stops, or shall we decide it on the previous 5 minutes before the candle? You should decide it at least 50 minutes before the news gets released. I'll show it to you tonight with some examples in terms of how we actually use the buy stop and the sell stop. So I'll explain it to you in a context as if we're going to get a news release tonight. We don't have any news release tonight, but there are going to be something that could happen with the yen crosses, so we can actually try to use that on those, okay? Could you please tell us how institutional or banker trades using news calendar? What kind of leading fundamental indicators? Which is their choice? The answer to this is that institution and the big banks typically avoid news releases, right? They would accumulate the positions before the news gets released, and if the news release is against what the market has been pricing in, then they use that news release to actually get out of the position, right? That's probably why you see a lot of spikes here and there. But typically, in terms of entering the market, it's really more position adjustment rather than anything else. Some of the key data that they use to trade, I think it would be more on the qualitative side. For example, the central bank announcements, the monetary policy decisions, those are going to be the key fundamentals that they trade on, right? In terms of the employment data, if it's a huge miss or a huge gain, then that's probably when they would actually act as well. But if the data is not that much different from the consensus, I don't think there's actually going to be any reaction to that, because you need to understand the context on how these big traders trade. They don't get in and out of the trade manually. If they were to do it, they would actually have a very sophisticated algorithms to do that for them. But in terms of opening a trade just on a data release, they actually don't do that. It's more on avoiding volatility. They have a lot of people that they have to answer to if they do something a little bit funny. Okay, so the answer to that is I actually don't do much of news trading. Okay, they would actually have their positions before that. All right, so let's talk about some of the news type, and obviously there's a lot of stuff that we can talk about. We do have some example, but news are basically divided into two categories. Number one are the hot, unexpected news. This would include terrorist attacks, military conflicts. This is something that happened last week. We saw a huge movement in the market because of that, and natural disasters. The other thing is that, with the yen crosses that I've been talking about for weeks now, the intervention that could happen, that is actually unexpected news, right? These are going to be unscheduled news because that's going to be a reaction from a government to defend their currency. In this case, that's going to be the Japanese government defending their Japanese yen. This is a high risk, unexpected news that we can anticipate, right? Which makes it kind of in between. It's not really unexpected. We kind of expect it. We have a certain parameter that an intervention could happen. For example, if you take a look at the dollar Japanese yen, it's kind of nudging that 152 level, right? So it is actually going to be very interesting because a lot of traders out there thinks 152, it's kind of that line on the sand, right, for the Japanese yen. It should not cross that level. If it crosses that level, then the Japanese government can at any given moment intervene in the market. Unpublished, obviously unpredictable, because they could do that when you're sleeping. They could do that at any given moment when they feel fit to defend their currencies. Okay, so those are going to be our hot news. These are going to be our unexpected news. We can, to a certain degree, anticipate what's going on. For example, the conflict in Gaza, in terms of how last week Iran suddenly got dragged into the conversation. This is actually something that we have been warning ever since the conflict started, that it could actually get worse if Iran starts coming into the stage as well. Okay. So yeah, we have unexpected news, but some of this unexpected news we can prepare ourselves. We can anticipate some of the changes. Okay. All right. Next thing is periodic news that comes out regularly. It includes the following reports. For example, if you're looking at the stock market, you're going to be looking at the earning reports, and we are actually starting with the first quarter earning seasons this week. I believe the banks are going to start their earning seasons this week. The tech sectors are going to be publishing their earning reports next week and the week after that. Okay. So for the Forex market, we will look at central bank meetings and monetary policy decisions, because Forex market reacts to them when they raise or lower interest rates. And for this week, we have the RBNZ, Royal Bank of New Zealand. I believe that's going to be tomorrow. We have the Bank of Canada, which is, I believe, going to be on Wednesday. And then we have on Thursday the ECB. These are scheduled monetary policy decisions. Obviously, they do carry a market-moving event, but this is more on the qualitative side. So it's actually a little bit harder to trade as a news release, because of the nature that you need to understand a little bit more on the fundamental analysis. Okay, quarterly GDP reports, these are important. I think this week we have, I believe it's on Friday, we might actually have the monthly GDP reports coming out from the UK. So yeah, GDP reports, those are something we look out for. Inflation, all right, we have the CPI on Wednesday, the PPI on Thursday, and obviously both of them have the core CPI, both of them have the core PPI as well. So yeah, inflation report, and then about the end of the month we will have the personal consumption expenditure, which is something that the Fed actually focus on a lot more than the CPI or the PPI. And then we have the indices of business activity in manufacturing and services. So we have the flash manufacturing services, flash manufacturing PMI, Flash Services PMI, ISM Manufacturing PMI, ISM Manufacturing Services, ISM Services PMI. Okay, so the PMI numbers, right? Purchases Managers Index is typically separated into a manufacturing number and the services sector as well. Unemployment data, this is something that we talked about last week. This is the labor market. Okay, so we took a look at the NFP numbers. We took a look at the unemployment numbers last week, and we discussed that during our live NFP trade. So if you want to see the recording, feel free to look for it on the channel. It was just last Friday. Okay, so again, these are going to be the two categories of news that you can actually trade, which is the unexpected news. A lot of this, it's going to be really hard for us to react to those news. I think the question just now about institutional doing a news trade, if there is an unexpected news and they need to kind of unwind their positions or enter into the positions, those institutional and banks will react to this unexpected news a lot more. So you will actually see a lot of quick one-directional price movement. Okay. Why we only talk about gold and forex? Why don't we talk about indices like Nasdaq? Yeah. I actually do talk about the indices, right? I actually do talk about Nasdaq. I actually have a specific session to talk about the stock market as well. It's just that I don't have the opportunity as of yet to in 2024 to be scheduled to do a live market analysis for the English speaking. I'm actually doing live trading sessions and live market analysis for Bahasa Indonesia, and we freely talk about the stock market. So if you actually have any questions, if you find these sessions and you want to use a stock market as an example, we are more than happy to talk about the stock market, okay? Because you can trade the stock market with Octa on the MT5 platform. So if you're curious and you're still on the MT4 platform, if you want to dabble into the stock market, then you can move to the MT5 platforms, and there's actually a lot of selection on the individual stocks as well. But yeah, NVIDIA has been great. SMCI has been great. We look at AMD as well, Qualcomm, Microsoft. Apple, not really too interesting at this point in time. But yeah, you're right. We can talk about it. It's just that no one asks about it. So we go with the majority where, people just ask, every time I do a live session, people always ask me about gold. People ask me about currencies, but it's actually very rare that anyone asks about the stock market. I trade stocks for a living as well. I'm a stock investor. I'm also a futures trader, so I actually do all markets. Not much on the crypto side of things. I do crypto for fun, but for a living, I do trade the stock markets, especially in the first 2-3 months. I would say the first quarter of 2024. A lot of my focus is actually on the stock market themselves. What is better for beginner? Forex, gold, or indices? I would say Forex. Indices, you would need to have the understanding of the stock market. Gold, I'll be honest, I think for gold, it's a little bit too risky for a lot of beginners. But I understand the appeal with gold here, because a lot of traders, when they come to the market, right? Obviously, first and foremost, if you take a look at Octa, I know they changed it to Octa Broker right now, but they used to be called Octa FX, right? So the main business is obviously the Forex market. Gold is a futures contract that is usually part of a Forex broker's business, right? But as the more of the offering goes by, obviously the change on the name goes to emphasize that, hey, you know what, there are other assets to trade as well. But the allure here and the appeal for beginner traders to gold is that there's a lot of hype. There's a lot of talk about, hey, you should be trading gold because you can actually make a lot of money. It moves a lot in a short period of time, and that's where the appeal is for a lot of traders. But new traders don't understand one thing. At the same time, because the range is huge, you can actually make a lot of gain in a short period of time with gold. But at the same time, if you don't manage your losses properly, you can actually lose a lot of, you can actually blow your account up really quickly as well. So maybe the appeal here, why a lot of people are trading gold, because they have the thought of getting rich quick. So I wouldn't actually um, tell new traders to go and trade gold, because you have to understand the specific movements that impact gold, because gold as an asset, it's not a currency, it is a commodity. You need to understand why it's actually a commodity. Why does people need gold, right? What is the purpose of gold as an asset? And that's a completely different thing that a lot of traders don't understand. But gold is mainly a safe haven asset. It's driven by, you know, conflicts, for example, uncertainty in the market. If people are worried, they prefer to have their investment in gold. But the cost of holding that gold position scales up with interest rates in the market as well. So if the interest rate is higher, the cost of holding the position in gold goes higher with it as well. So there's actually a lot of different mechanics that's different. So if you are a newbie, if you're a beginner, Forex is kind of the right balance there, but I would say go with the major currencies. Um, Gold, if you have an understanding of the commodity market, if you have the understanding of the needs, then yeah, you know, by all means go for it. But I wouldn't recommend that for beginners. The indices, if you come from a stock trading background, then the indices is probably going to be an easy one for you as well, because if you understand the mechanics of the stock market, then you can actually trade the indices. And it is actually a much simpler way of looking at the stock market, because it's kind of everything just average in one whole index. Okay. All right. So let's move on. So these are the three main phases of price movement. We need to understand the accumulation. So the most informed and forward thinking obviously answers here, and then we have participation. You know, people that understand technical analysis will enter that trade. And then the distribution is when a lot of retail traders that don't understand what's really going on, they saw a lot of people buying into the market, and they say, oh, you know what, it's going up right now, let's just jump in, right? So I would equate this situation with gold at the current state. A lot of traders will look at that and say, oh, nice, you know, gold's going up, it's going to go to 3,000. I don't know, I don't think that's going, it's going to happen soon. But once it starts trading above 2,100, 2,200, obviously everyone is hyped up, right? That's probably where it would actually be in that distribution phase. It's no longer in a participation phase, and it's definitely not in an accumulation phase. So you need to understand the three different phases that goes on in the market. And you need to be able to identify this before the news release, because if before the news gets released, everyone is already trading in their position, market is already moving, everyone is already participating, you typically want to stay away from that news trade, okay? That's why I hated before the CPI, for example, or the NFP market, the market started moving in one direction. It becomes hard for us to kind of create our stop orders. But good enough. And a lot of our successful trades happen when the market is actually flat during the accumulation phase. That's where we can safely place our buy stop and our sell stop. Okay? All right, cool. So those are the three main phases of price movement. And then there are obviously some general rules for news trading before we go on to the pending orders. You need to study the market and analyze the dynamics of a currency pair. What do I mean by this is that you need to understand what you're trading. You don't need to understand it from the context of what's going on from a technical analysis point of view or a fundamental analysis point of view, but you need to understand the characteristics of whatever you are trading. So you asked me the question, Syed asked me a question on, you know, should we trade gold? Or should we trade indices? Or should we trade Forex? It comes down to you. Do you understand that asset? Okay? If you understand gold a lot more than Forex, for example, excuse me. Right. So if you understand gold more than 4x, then feel free to trade in gold. But if you don't understand gold, and typically you want to avoid that during news releases. Now, last week, as an example, if you missed out on the live trade, we had a stop order and we had a buy stop and a sell stop order for gold. It wasn't triggered within the first 5 minutes of of the news release, and I actually canceled the order. If the order was triggered, it will actually go really bad. So I'll just show it to you here right now, what's going on with gold, right? So here, what we have, the two lines, the 2296 and the 2275. During news releases, what happens was that it breaks to the upside and then it breaks to the downside. So it will actually trigger both sides, okay? If I were to zoom out a little bit, some of the orders was actually, sorry, these two orders were actually sell orders, right? The two red lines that you see here, those are the sell orders. So if I were to leave the trade open, and if I didn't close it, it would actually blow up my account, okay? Because I had two sell orders, one at 2296, one at 2275. If you get it at 2296, that's great, right? But if you get it at 2275, it only dips down for about 2 hours and then it reverses back up. So for those that don't understand gold, they would probably keep the trade open because the thought is that, oh, you know what, the US dollar is strong because the US employment numbers are strong. That's going to push gold a little bit lower. But for us that understand the mechanics for gold, it is not quite related to whatever the news release was on Friday. So if we don't have that initial reaction within the allocated time, we need to get out of that trade. So this is what I mean by understanding the dynamics of that particular assets itself. It doesn't have to be a currency pair, it can be any assets, okay? Now the second thing is obviously assess the reaction of the asset or the currency pair to the latest news, right? And prepare for trading by marking relevant levels on the chart and decide on your tactics, including when to open and close the order. For me, I would prefer to get in and out in the first minute if possible. If I see because what we did during our live trade is that the gains might be small. It might be only 10 pips, 20 pips, 30 pips, but we open a position on, let's say, 5 different currency pairs. So it all adds up. So, 20 pips, which is small, and it's logically achievable with such a news release, because typically with news releases like this, if it has a high impact and if it moves the market significantly, it will actually take the market above 50 pips. So we're talking about 60, 75 pips in a short period of time. So we're not aiming for that 50 pips for every currency pair. The logic here is that we open up 5 different pairs. We want to accumulate a total gain, right? So it can be 20 pips here and there. 20 pips on 5 currency pairs, that's already 100 pips. That's a lot in 1 minute's time window. So you kind of have to make that compromise, right? If we're trading this on a swing trade, that's completely different. I would go for one pair with 50, 60, 75 to 100 pips. That's completely fine. But news releases, I think the key to success in news releases is to get in and get out as soon as possible. Do not let greed take over. I think that's the key to success in news trading. So the rules are there. You just need to understand what's going on, because you need to decide on when to open, when to close it, what time frame you want to be trading it on. You want to do it on a 5 minutes, 15 minutes, an hourly time frame. And then you need to determine the risk for each order as well. And you kind of need to consider using stop losses or maybe trading stop loss. You basically need to figure out the risk side of things. Should you move your stop loss to break even if you're already locking in some of the profits, or maybe the market is going 50 pips in your favor, you want to lock in 20 pips. You kind of need to decide on those strategies yourself, right? I can show it to you together during live releases, but in terms of managing your own trade, you kind of need to do it yourself, okay? So decide on the terms of the deal. What do you want to do with it? Whether you want it to be a quick trade or you want it to be a longer trade, it's completely up to you. Last week we did something different. We have that as a little bit of a longer trade. We leave the trades running for a couple of hours. But typically during news releases, if I like what I saw, if I get about 100 pips, I would close out all positions. It doesn't matter what direction it is. I just want to get in, I just want to get out and make some profits out of the market. Simple as that. Okay. But at the same time, if you saw your losses adding up as well, you kind of need to decide whether you want to close that trade or you want to leave that to a certain stop loss. So there are rules to follow, but these are just general guidelines, okay? All right, so let's go quickly. These are some of the examples of the pending orders. Before I jump in onto the practical side of things, let me just cover all four at the same time. Okay, the strategies that we typically use during news releases are the buy stop and the sell stop. Okay, that means market is not moving, it's kind of a little bit flat, and I have an order above the current market price. If it goes up, the market rallies up, breaks to the upside, it will hit my buy order and will take me to the direction of the market's trend movement. Okay, and obviously if it goes down, it will trigger my sell position, so I will go with the flow of the market. So we are going with the flow of the market. So I think that's the easiest way to understand this. I know it says stop, right? But it's not really stop. So buy stop is actually going with the flow. If the market goes up, you want to be in a buy position. If the market goes down, you want to be in a sell position. Those are going to be your buy stop and your sell stop. It's one directional. Okay. The limit orders, you basically have a sell limit on the upside. If the market goes up, hit a certain level, and you expect that level to be a resistance, then you want to use a sell limit. Okay, if you expect the market to go down a little bit, find a little bit of a support before bouncing up, then you want to use a buy limit order. So the sell limit and the buy limit order, to a certain degree, you need to understand your technical analysis. Because if you are not able to find a resistance to use those limits, because you need a reason to convince yourself or actually to kind of make sense of what's going on in the market, that you have the confidence that when the market is going up, it might actually get rejected and you want to sell at the very top, right? So those are going to be the limit orders. So the limit orders are a little bit more technical. You need to understand you actually need to be really good with technical analysis. You really need to be able to use some of the indicators to kind of figure out where's my limit order going to be, because in essence, there's actually a huge risk attached to the limit orders, right? So go again with me here. The stop orders are basically going with the flow. If the market goes up, you want to be buying. If the market goes down, you want to be selling. So that's going with the trend. But limit orders are different. When the market is going up, you want the market to go down. That's the limit orders. So in essence, there's a risk attached to it where you are going against the trend. So that's the difference between the pending orders here. So there are going to be four types of pending orders: buy stop, sell limit, and buy limit. Okay? All right. So let's take a look at the buy stop and the sell stop strategy. What we need here, as I said, let's go back here a little bit. We want the market to be in that accumulation phase. So we need to see that corridor of volatility. We need to see that the market does not go out of range. Once we understand this, we can create a buy stop above the range and a sell stop below the range. And this is basically what we did for every news releases, right? So you definitely want to be looking at the market in a consolidation phase. That's where we want to have our buy stop and our sell stop orders. Okay, so if the market breaks to the upside, then your buy trade is going to be triggered. And what we did is we will always cancel the other order. So with this example, the buy trade, the buy stop was triggered. You are in a long position. You want to cancel your other order because you don't want to see the market reverse and take your other order. Then you're going to be hedged. Your position is actually going to be locked. You're basically locked in negatives, right? So be very careful. So I would say with news trading, if you're not experienced as of yet, I would say limit your trade to just one or two currency pair. Don't open a lot of trades, because once things get moving really quickly, you might panic and you might not be able to control all your positions. So be very careful. Okay. So in this example, we saw that break to the upside. The market is going up. we go with the flow, right? We want to have a long trade. Now, you obviously need to have your stop loss. Your stop loss can be at the sell stop. For this one here, on this example, it's kind of halfway in between. At the previous resistance, it becomes the stop loss. If you want to have it safer, once it goes up and you're already in profit, you can move your stop loss to break even and turn it into a risk-free trade. This is also one of the strategies in terms of managing your risk as well. Okay, but for me, instead of the market reversing and taking me out at zero, I would be very happy with whatever the market gave me. If it's 10, 20 pips within a short period of time, typically within the 5 minutes window, I'll be more than happy to take what the market give me. Okay, but again, that's me. You might have a different strategy. In this example here, we can show you that you can actually move your stop loss to break even, then it becomes a risk-free trade. Okay. All right, I'm not going to go into the practice now because I want to talk about the limit orders first because we're running out of time. But with the limit orders, for example, on this one here, this is the reason why you need to have an understanding on the technical analysis. You can actually look at the SMC webinars. This is a webinar that we did at the beginning of this year, I believe the SMC, or was it end of last year? But we did the SMC webinar. And some of the basics there in terms of finding out your key support and resistance is actually in those webinars. It's a 5-part webinar. You can find it on the Octa Broker channel as well. All right. But for this one here, we're looking at the local previous high, right? We're looking at the previous high. There's actually an order block at that previous high. So we are looking at the assumption here that the market is currently moving down. However, if it does ever goes up to that level, for example, during news release, right? We might actually see the market spike up, okay, come back to that level and find that level as a resistance. In this case, we want to use the sell limit because I can't use the stop orders because the market is already moving down. But I'm trading on the assumption that if it spikes to the upside, I can open a short position up there, which is going to give me a very small stop loss because it's at the upper end of the resistance. And if the market spikes there during news releases and find that level as a resistance, it will drop down. That's kind of the logic behind it. So that's basically with the example here. So you have that sell limit order just around those order blocks, and this is the reason why we call them order blocks, right? Because there's a lot of orders line up there, okay? So we saw this happen, market spikes up, take our order, open a sell position, you have your stop loss above that swing low, the swing high, then your stop loss is actually really minimal, and you can see a very quick sharp drop to the downside. So again, this might sound very appealing, right? This might sound like, oh wow, I can predict the future and whatever not. It carries a much bigger risk with it because you're actually going against the trend during that news release. What if during the news release it spikes up and continues to go up? The good thing is your stop loss with the limit strategy, because you're opening your position at the very top of a support level, at the very top of a resistance, or at the very bottom of a support level, your stop loss is actually very close to the nearest swing lows that you open your position. Therefore, your stop loss is logically very small. Your risk reward ratio is actually going to be much larger as well. But as I say, this is a bigger risk with a bigger gain, right? So it's relative in terms of gain and risk. They're relative. You want a higher gain, go with a higher risk. Okay. All right. So let me go and show you what's going on, and I will actually use the dollar Japanese yen to highlight one thing. We are borderlining the dollar Japanese yen. You're not able to see this clearly, so I'm actually going to switch to trading view a little bit so you can actually see the key levels. So this is the dollar Japanese yen. It technically has never exceeded it spikes out there a little bit, right? It never exceeded 151.97, right? And market is pushing it up right now. And we have support at 151. So if we are looking at the dollar Japanese yen, we are on the assumption that, we can anticipate a certain news to happen, which is the intervention, right? But before that intervention, obviously we could see a little bit of a break to the upside. Now I can show you two examples here on the dollar Japanese yen. Right now you can see the range here. We have support at 151. We have a little bit of resistance at 152. So I'm going to place two orders. Let me clear that box there for you. Okay, so I'm going to cage this at 152. Parameters 152 as our resistance. And then our support is going to be at 151, right? So this is the current range that we have here on the daily time frame. And then we'll move on to a small time frame. Okay. So what are we looking for? There's actually a little bit of an accumulation phase that goes on in the dollar Japanese yen. You can see that very clearly here. The market is just going flat here. Okay, so I'm gonna go into a small time frame, and all of a sudden the range is just huge. Wow, it's been going on for a long period of time. So a breakout is actually imminent on the dollar Japanese yen. So you have a few things to consider. Should you have a stop loss, a buy stop? Let's say about 152.25 just in case it spikes up. Or should you have a sell stop below 151, maybe about 150.75? There's reason why we go about 25 points here and there, but you know, you can do this, right? You can take a look at this and say, oh yeah, you know, I'm expecting a breakout to happen. If it does break, it might rally to the upside. But some traders might look at this and say, you know, maybe I shouldn't do a buy stop, just a buy stop, because right now I can change the buy stop and have my profit take profit level at 153. So I have a target at 153. So therefore, assuming the market goes to 153 and then the Japanese government intervenes, right? Because for them to intervene, it does take time. So we might actually see price rally up beyond 152. It might get stopped out at 153. And then, you know, about 153, we expect the Japanese government to kick in, for example, with a potential intervention, right? Because they saw the Japanese yen is now above 152. If we don't intervene now, it might go to 155. That's going to be a huge hit for our currency. So they might take time to place their order, but I think a lot of people are also thinking about how I'm actually looking at the market is that at about 153, it is actually a good idea to create a sell limit. All right. So what we want to see is, let's see if I can actually zoom in a little bit. All right. Okay. There we go. So we are expecting the market to break 152 and continue towards 153, and up top we expect a little bit more profit taking to happen, and that might push price back down to 151. So in essence, I can combine the stop strategies and the limit strategies, right? Because I can create a buy stop with the current range of 151, 152 on the dollar Japanese yen, but at the very top, once I take my profit for my stop orders, I want to create a limit orders because I think at 153 there might actually be an intervention that kicks in. A lot of people are actually going to be taking their profits at about 153 level. You have to consider this. The dollar Japanese yen or any yen crosses, as a matter of fact, is actually a carry trade instrument. So people actually hold it for a longer period of time. So we might actually see people holding their positions since 140, 145, 147. You know, to them, getting out at 152 and 153 is actually more than enough. It's a significant gain that they have actually accumulated. But this is one strategy that we can look at. Okay. The other thing is, for example, on the Euro USD, we actually have a limit order that was placed last week. Last week we anticipate the market to hit 1.08 and then bounce off. And that's why we have the limit order up top, just in case the market does bounce back up there. It will hit our sell order, and we're still in that limit order that we have here on the Euro USD. Okay, now, if we take a look at the corridor of volatility, for example, On the Aussie USD, is there a specific corridor of volatility? I would say, yeah, I think there is actually a corridor of volatility for the Aussie USD. Let me just clear that off. And you actually need to look at this area here. About there, price has never closed above that level. So we can actually look at this and say, okay, that's about the corridor of volatility that we have on the Aussie USD. Now, on the assumption that news is actually going to be released in the next 5 minutes, we can use this as an example. Where do we place our buy stop? Your buy stop will be placed above whatever high that is. That's going to be your buy stop beyond that level. Okay, so my buy stop is going to be about there. Okay, so I'll adjust it. My buy stop is about there, just beyond that range there, and my sell stop will be beyond this low here. So I don't want to be here somewhere in the range. We want to be outside of the range. That's why we need that corridor of volatility, and that's why we need to know the range for our stop orders. Okay. Please shed some light on how to trade after the news dissolve or everything comes down. Does it retrace back always? No, not really. In fact, it's only the NFP that kind of have that kickback or retrace or that pullback that happens after news releases. Typically with other news releases like the CPI, it's more one directional. Do we have that pullback? The logic is that we will see a little bit of a pullback, but it's not going to be all the time that it's actually going to be going back to the entry position. So if you have a position open and you are in the wrong, don't assume that it will always go back to zero and then you can cut your loss. It doesn't work that way. And most of the time, if we see a movement that goes in one direction, we see a little bit of a retracement. It's typically not 100%. But yeah, does it retrace back? Most of the time, yes, not always. Okay, so don't count on it as a strategy, because during NFP releases, in terms of the market retracing back, I think out of 10 NFP release, we might only see about, 4 times out of 10 that we see a market retrace back and go the other direction. But typically with the NFP numbers, the initial reaction is usually the right direction going forward. Okay, so yeah, trading after the news, you can wait. Obviously, once you see that pullback, then you can trade the news, right? You don't really want to trade the news without that pullback, because as a technical analyst, what you want to do as a technical trader, you really want to see the reaction in the market. You want to see the market goes in one direction, does a little bit of a pullback, and then you do your analysis there. So that's trading after the news releases. You want to be waiting for that pullback. You don't open a trade on the assumption that the pullback is happening. You need some sort of proof to trade after the news release. Okay. All right. So we are kind of running out of time. So for the quick test here, if you want to answer it, feel free to answer it, but I'm not going to give it a lot of time. All news can be divided into two categories. What are they? And what type of orders are most often used in news trading? What type of pending orders do you know by now? And when should you use those pending orders, right? I just gave you an example. I combine a stop order and a limit order in one potential strategy. And just as a little bit of as a disclaimer, the strategy that I showed you on the Japanese yen, the limit order is actually real. I actually do have a limit order at 153, and the take profit for all my long positions on the dollar yen is at 153. All right, so as a disclaimer, I've been carrying the dollar Japanese yen for quite a while now, and I'm waiting for price to break slightly above 152 on the assumption that it's going to take a little bit of a time before the market react to the potential intervention, or market gets scared of it. They will try to push it beyond 152, so potentially spiking a little bit to 153. Okay, so that's a little bit of a disclaimer. All right, so I'll just answer this for you guys. All news can be divided into two categories. They are the hot unexpected news and the scheduled releases. What type of orders is most often used in news trading? They are the stop orders, which is the buy stop and the sell stop. What type of pending orders do you know? By now you should know 4 of them: the buy stop, sell stop, the buy limit, and the sell limit. When should you use them? Typically with news releases, you want to use the stop orders. Only use the limit orders if you understand or you have a good grasp, a good understanding of price action. Okay, if you have a good understanding of technical analysis, then you can use the limit orders. But if you don't have that knowledge, if you don't have that experience, if you're limited, I would say stick with the stop orders and learn about technical analysis before even employing the limit orders, because limit orders just doesn't work on a gut feeling. They don't work randomly by just picking a level and attempting to counter the market. Okay. All right. So this is the code again. It's non-farm 2024. So make sure you are using this code when depositing into your Octa trading account for 100% deposit bonus or double your deposit bonus. Valid until the 31st of December 2024. And Q&A session. If you have any questions, I'll be more than happy to answer this. Okay. Other than that, what's next? We will have our live CPI trade. I think if you are on the Telegram channel, I think it still shows like it's actually tomorrow. It's not. It's on Wednesday. It's on the 10th of April. We will cover some of the theories on inflation, what's the CPI and whatever not. What are we looking for? And then I'll talk to you about the context of the inflation release on Wednesday. What is the consensus? What's market expecting? What's the potential scenarios? And then we will trade the CPI live that will be on Wednesday. All right. So again, let me know if there's any questions. I'll just wait here for a little bit if you have any questions. Okay, doesn't look like there's any questions, so we will wrap it up for tonight's session. So I'm looking forward to the inflation numbers on Wednesday, so make sure you tune in on the same time as today's webinar. That's going to be on Wednesday. With that, good luck with your trades, and I'll see you on Wednesday.